Hi, this is Linda Eedes. I'm going to give you an update on the RECM Balanced Fund. In particular, I'm going to talk about the fourth quarter, some of the management actions which took place during that time, and also how the portfolio is positioned currently. So looking at the fourth quarter, of course, the biggest event during the quarter was Donald Trump being elected as US president. That had quite a stimulatory effect on most developed equity markets, and notably, of course, the US equity markets, with expectations being that he will cut tax, that he'll increase infrastructure spending. That obviously, sort of boosted expectations of domestic growth. It also caused sort of interest rate expectations to be higher, and that also saw yields sort of rising amongst most developing economies as well. So the positive impact was for developed markets in the US in particular, but it had a bit of a negative impact on emerging market equity markets. So if you look at most emerging markets, they were actually down on the quarter, and that's obviously on the back of concerns with regards to rising protectionism and, of course, concerns about free trade and the impact that that might have on emerging market economies. South Africa was in that boat, unfortunately, so the overall South African equity market was actually down 2% during the fourth quarter. But the good news is that the RECM Balanced Fund actually did very well. So it also had an impact on industrial metals prices. The whole sort of Trumponomics ideas obviously is quite stimulatory for industrial metals prices. So you will know that the portfolio has got a lot of exposure to resource counters still, which would have benefited from a rise in industrial metals prices. So the portfolio actually returned 1.7% for the quarter, which ends the year off very nicely. It was a very strong year for the RECM Balanced Fund. The fund as a whole delivered 22.2% for 2016. And that really is part of a whole shift towards value and value investment styles. And of course, sort of the few years prior to that has very much been a market that's favored more kind of growth momentum styles. And we're seeing a tilt very much in favor of value. And we think that that is set to continue for quite some time if you look at the long-term sort of value versus growth cycle and where we are in that. So if you look at the positioning of the portfolio, if we take a look at the asset exposure, remembering of course that we don't have a top-down process, that all of our asset allocation is a result of bottom-up investment decision making, so where we actually allocate to each individual stock. You can see that equity has actually increased quite a bit during the fourth quarter. So it was up from about 50% to now, if you add the global and local equity components together, it's just under 60%. And that's as a result of a couple of new investments, both locally and globally, and also sort of allocating to existing ideas where there was a little bit of weakness. If you look at the sort of broad asset class split, you can see that the favor is very much still towards local equities. That is a function of not only that opportunity set in itself, but also the rand. Of course, this fund looks at investment ideas in rands, and the rand being undervalued on a sort of inflation differentials basis means that global investment ideas have a much higher hurdle to actually sort of meet our criteria of being both cheap and high quality to be included in our portfolio. So that explains why the global portion of the fund is a little bit smaller. And you can see we do have some exposure to South African bonds, but that remains largely unchanged from the last quarter. Yields did drift upwards, which was a trend across the globe, but they're not really at levels yet where we sort of think that there's value such that it would justify a much larger allocation to South African government bonds. Looking at the top 10 of the portfolio, you can see again that that's become a lot more diversified than it was historically. Just looking, for instance, at resources versus other kind of sectors in the portfolio, even just looking at this as a kind of demonstration of how the broader portfolio looks, you can see that there are only a few resource stocks in the top 10, whereas 2 years ago you would have seen the majority of the top 10 would have been resource stocks. So you can see Impala Platinum is still there, Anglo Platinum is still there. Those two stocks obviously actually came off a little bit in the fourth quarter. We actually added a little bit to them. BHP Billiton is still there. We actually pulled that back a little bit. Sasol is still there. But the other stocks in the top 10 are quite a varied mix. You've got sort of HCI, which has got quite a lot of gaming and leisure exposure. You've got Standard Bank, which is of course the banking group. You've got Richemont, which is luxury goods. Altron, which is actually one of our new investments, which is obviously a technology group. But yeah, I think that represents sort of the broader diversification we've seen. It has been a trend throughout the course of the year, which of course is a positive thing for the portfolio as a whole. So I mentioned that there are a few new investments in the fund. That's on the local and the global side. Just to give you sort of some idea of that, I've already mentioned Altron, which is of course the technology group that was struggling for quite some time. They've been through quite a restructuring exercise, a sort of movement away from being a very family-owned and controlled business to more of an independent management structure, which we think is a positive. We think that will unlock further value, and we think that the prices at these levels represent significant upside from this point onwards. We also allocated to Clientele. That was a new investment in the portfolio. That's of course the market leader in terms of direct sales of life insurance to South African consumers. The market's been a little bit short-sighted, we feel there. Of course, the economy is quite difficult in South Africa, and obviously that will have a bit of a knock-on effect in the short term on their sales, particularly to the lower income segment of their market. But we think sort of looking through the cycle that the pessimism is overdone. So the prices at sort of current levels do represent significant upside if you actually look a little bit longer term and calculate the fair value for the group through sort of multiple cycles. On the global side, we've actually bought in two new banking stocks, but very different banking stocks. The first is a UK bank, Royal Bank of Scotland. Obviously, this group went through a very tough time during the financial crisis, was bailed out by the UK government, has also been through a massive process of restructuring and cost cutting, dealing with litigation expenses, and so really kind of getting back to focusing on being sort of a UK core bank. We think that's a positive, and we think that at current prices there is also a discount relative to fair value. The other banking stock, but in a very different part of the globe, is Eedes. This is the leading and most profitable Brazilian private bank. And the Brazilian banking cycle has been through a bit of a low, and that's actually given us the opportunity to buy Eedes, which is a fantastic business, highly profitable at very attractive prices. There were other new investments in the portfolio as well, which is also why the equity exposure did rise a little bit in the portfolio. So looking at the portfolio as a whole, I think what you have is a very diversified set of investment ideas. It still does have quite a chunk of cash, which we think is appropriate for where we are in the cycle. We think that one can't compromise on the sort of dual criteria of focusing predominantly on quality businesses which are trading cheaply. We will allow a small portion of lower quality businesses which are very attractively priced, but we really want the portfolio to always be tilted towards the higher quality segment of the market. So how much low quality we have is very much determined by how much high quality we have in the portfolio. We want that tilt to really much remain in favor of high quality in order to keep that portfolio as robust as possible. So I think the way that the portfolio is positioned reflects the fact that there are value opportunities out there. RECM is of a size that enables us to take those opportunities. Some of the new investments which I spoke about are smaller companies which are quite frankly not available to larger asset managers in terms of accessing those value opportunities. And we think it is very early days in terms of the value cycle. If you actually look at it from a sort of a longer term perspective, that shift is very much in the early stages, and we think that that is set to continue.